There is a saying in the investing world that you shouldn't invest into something solely based on the fact that others are investing into the same thing. So in this video, I'm going to go and look at the most popular ETFs in my broker of choice and see whether or not over the past year that would have been a good decision if you had just gone into the app and went to the most popular ETFs. So for this video, I'm going to be using the app Trading 212, which I think is the most popular for my audience and the majority of people on YouTube really. If you would like to sign up to Trading 212 and receive a free share worth up to £100, then all you have to do is use the link in the description down below. Alternatively, if you signed up to the app less than 10 days ago and haven't received a free share, what you can do is enter the 3 horizontal line menu button over here. Scroll slightly down until you see the use promo code section over here. And in this menu, you can use my personal code JUBAIR. And once you apply that, you should be able to get a free share. So remember, if you don't like Trading 212, that's absolutely fine. This video is going to be applying to the majority of other good UK-based investment brokers too. So on Trading 212, all you really have to do is hit the magnifying glass icon down here, and if you scroll all the way down and a bit more, you can see a section called most popular ETFs. Now if you've seen any of my investing guides before, I warn people to not go into these sections and pick out a fund just because it is the most popular. In fact, just because something is very popular really doesn't mean it is going to be a good investment. We saw not too long ago, for example, GameStop shares, which were really popular, but the reason for the popularity was actually because a lot of people were shorting the stock, which in the long term is not a great strategy, and a lot of people ended up losing a lot of money. In any case, in today's video, we are going to be looking at exchange traded funds. Now, the majority of good ETFs are actually pretty safe in the long term because they are well diversified. But remember, these days there is an ETF for absolutely everything. So not every ETF is actually created equally. But anyway, let's go into this menu and see what the top ETFs are. So as you can see, Trading 212 says that these are popular ETFs based on user activity. And for the first one, we have the Vanguard S&P 500. If we go into it, you can see this has the ticker code VUSA, and this is the distributing version, meaning that dividends are paid out to the shareholder, i.e. you. You can see that I actually hold a very small amount, £1 of initial investment into the VUSA, and I probably just did this because I was probably doing a video tutorial on how to buy £1 worth. But one good thing with Trading 212 is that you can easily buy £1 worth of many of these stocks. Fractional shares, of course, you're not going to get a full share with £1. But anyway, at the top you can see the value of the fund currently. That doesn't really say anything that you can use to compare against other ETFs. However, the percentage growth is what we're going to be focusing on in this video, because you can see what constitutes a good ETF or any sort of investment is that it gives back the investors a good return on investment. Ideally, we should be measuring this over a 20-year period at least, just to see how it performs over the long term, because in the short term, we know in the stock market, there's always a lot of fluctuation. But for the purpose of this video, let's say you were a brand new investor who has just been investing for the past year, how just by choosing these ETFs, you would have fared, over the past year. So you can see actually the most popular one, the S&P 500, actually did really well over the past year, up by 22%. Now, it is very important to understand what the ETF is actually tracking. This one's very simple because this is the S&P 500. Of course, you can look into the data sheet for the ETF to find out more about this. And unfortunately, Trading 212 really is lacking information about these ETFs, especially when it comes from Vanguard. I know with iShares, they do have information. Remember, I'm not sponsored by Trading 212, and as much as I love the platform and I talk all about it, you might be even fed up of me talking about it so much. I can say whatever I want because Trading 212 doesn't pay me for these videos, and I really wish they would actually get their act together and add some information about these ETFs. But anyway, there is always a third party that you can go to, for example, Just ETF. Here you can search the ticker code. So for example, this is the 3 or 4 character. Usually it's 3 or 4, sometimes it could be 2. You can see over here it says VUSA. If you put that into Just ETF, which is a completely separate entity to Trading 212, you can find out more about the underlying ETF. So as you can see, if we type in VUSA, we get this one here, which is the Vanguard S&P 500 UCITS ETF. And here you can actually find out pretty much every everything there is to know about the ETF. This is a very important number here. This is the total expense ratio, a measure of how much the fund costs to run. You will never actually separately have to pay this fund fee. This comes out of the value of the ETF. If you want to know more about that, I have a video on my YouTube channel that will explain more about ETF fees. But anyway, if I go into holdings here, it will show you the top holdings and the top countries. For me, the most important part is the countries. So this fund, heavily being focused on America, of course the S&P 500, is pretty much 99% in the USA. It does say other, but for example, Ireland, we know that US companies are based in Ireland for tax purposes, like Amazon and stuff like that. But I'm not going to go into those details for the purpose of this video. But you can see this tracks the top, let's say 500-ish companies in the USA. I think we all know that by now. So anyway, if you had gone into Trading 212 and, gone for the most popular ETF, you actually would not have been doing too bad at all. I would personally not be disappointed with a 22% return over the past year. Of course, in the short term, there are definitely fluctuations that we're going to see. For example, the fund was worth a bit more just a couple of days ago, and then it does go up and down, but that's very normal for the stock market. You can see as far back as we can go on Trading 212. For example, December 17th, the fund was worth £37 and now it's 80, so it's more than doubled since 2017. And of course, we know by now the S&P 500 in the long term has been averaging over 9%, which is an absolute great investment, and I hope it does continue. Now, the next fund is basically the same thing, the Vanguard S&P 500 again, but the difference here is that the dividends that are paid out from those companies are reinvested automatically. You can see therefore that compared to the VUSA, the VUAG, as you can see by the ticker code over here, has actually been performing better because the dividends were reinvested automatically. If you reinvest the dividends manually from the VUSA, then you can actually achieve a very similar number. And you can see over the past year, if you had randomly gone into the top two and selected either one of them, with this one in particular, you would have been up currently by over 24%, which is an absolute dream. So now as we go to the third and beyond, we're going to get into a bit more obscure ETFs. For example, let's go into this one here. Now you can see this is called the iShares Global Clean Energy, and this is where the warning of the video comes in, because just because something sounds good, it's popular, it sounds like you're going to change the world by investing into clean energy. You can see this fund over the past year has actually lost investors 14.57%. In fact, if we go into the maximum, we can see that in 2021 it actually peaked, and since then it has been steadily declining. Another peak 1 year afterwards, but then all the way down. Over the past year, if I had an ETF that was losing me 14.57%, I would really be upset, especially when we go into the max. There is absolutely no indication that this ETF is going to recover at some point in time. Therefore, it is incredibly important to find out what the underlying assets are for this ETF. Now, luckily, because this is from iShares on the Trading 212 app, we have a lot of information. For example, the expense ratio, you would also see that the expense ratio is incredibly high at 0.65%, which is around 9 times higher than the S&P 500 from Vanguard. We can also see that the dividend yield is 0.85%, which is actually even lower than the S&P 500, and the S&P 500 is not known for its dividend yield, currently being around 1.1 to 1.2%, or roughly around that area. So you can actually see the average annual return here, a 1 year annualized return being negative 31%, 3 years annualized return being minus 14.97%. Over the past 5 years, however, annualized returns have been 10.67%, and 10-year annualized returns 4.7%, which is actually not that great when you consider that the S&P 500 has been doing a whole lot better. Now you can also scroll down to see the top 10 holdings. These are all energy and solar companies. For me, the most important becomes countries first, so 33% in the US, 9% in China, 9% in Denmark, so on and so forth. However, when we look at sectors, we can see 59% utilities, 18% industrial, 18% technologies, so on and so forth. Now, I'm not saying that this ETF could never recover, although we just generally don't know if it will ever reach back to numbers it was before and how poor of an investment it is. Generally speaking, we do compare ETFs with the benchmark, which is the S&P 500, and this has been doing a whole lot worse, especially considering if you had invested a year ago, you would be down by nearly 15%. Now, the next fund is also an iShares fund. This is the iShares S&P 500 Information Technology sector, also an accumulating fund which reinvests dividends automatically. You can see over the past year, this fund would have returned you 38% absolutely crushing the S&P 500. So if you randomly had stumbled across this and invested into this last year, you would have been very happy because this actually beat out the S&P 500. Now it's important to of course know what this is invested into. You can see the expense ratio is very reasonable at 0.15%, about double the cost of the VUSA. However, of course, it's more of a niche ETF, so it will be costing a bit more. Of course, no dividend yield because this is a accumulating ETF. You can see top companies are all basically the Magnificent Seven: Apple, Nvidia, Microsoft, Broadcom, AMD here. Now, if you go into countries, of course, this is a derivative of the S&P 500, so 99% will be US based. And if you go into sectors, of course, this ETF is thematic in the IT sector, so information technology. So yeah, if you had stumbled across this ETF, you would have been a very happy person. However, let me tell you this, compared to the S&P 500 on its own, this is a whole lot less diversified as it just focuses on IT companies. And IT companies, you know, although they're doing really good right now, nobody knows in the future what their valuations are going to be overall. So long term, we actually don't know if this is still a good investment to keep holding for the future. Now, the next one would be in the iShares Core S&P 500, the SXR8. And of course, if you have just stumbled across this, you need to be careful because this is denominated in euros. So if you are a UK-based investor, then if you want to buy this, for example, you will have to exchange currency, and that comes at a cost on all brokers. On Trading 212, it's pretty low at 0.15%. So just because of that, I can't really recommend this ETF. Now, the next one is a very popular ETF, and that is the VWRP. So this is an all-world index that is provided by Vanguard. You can see this is also an accumulating version. And over the past year, if you had just invested into this, you would have been up by over 20%, which is absolutely amazing. However, the S&P 500 does slightly beat it out. This is basically around 60% of the S&P 500 anyway, so you're getting huge exposure to the S&P 500 whilst also being diversified with markets around Asia, Europe, and the rest of the world. The next most popular would be the VHYL. Now, this is basically an all-world fund, but focusing on dividends, something that I'm very hesitant to ever talk about because I firmly believe if you just as an investor focus on dividends, you are putting growth on the table because a company that pays out dividends is a company that couldn't use that cash to reinvest back into its business. But in either case, if you had invested into this fund over the past year, you would have returned 10.51% in returns, which is less than half of what the S&P 500 actually returned. However, that being said, the dividend yield on this is a lot higher than, of course, the S&P 500, but even including those dividends, the S&P 500 or the FTSE All-World would have given you a whole lot more return. So let's go through a few more examples. Let's actually focus more on the more obscure ones, which are coming up on the popular tab. So this fund is from iShares and it's physical gold with the ticker code SGLN. And you can see that this ETF basically allows you to essentially own physical gold, but not really own it and have it in an ETF. Over the past year, this has actually been doing really, really good, surprisingly up by over 25%. So actually beating out the S&P 500 itself. Now, if you want to learn more about this fund, you can read about it here. I would have to do more research about it to understand how the gold plays a part of this ETF, whether it's actual physical gold or something that is tracking. But, you know, for the purpose of this video, we can see the expense ratio is pretty decent at 0.12%. Looking at average annual return, you can see 1 year annualized return 15.94%, which is really good. However, 3 year annualized return only 4.78%, and the 5 year annualized return 10.64%. This definitely has been quite surprising for me, and if I hadn't made this video, I wouldn't have realized that gold was doing so well. Now, another interesting one here, the Vanguard UK Gilt. Now, if you didn't know, Gilt is the UK name for government bonds, and this fund gives you exposure to gilts. You can see this is a distributing fund. Over the past year, this fund has returned investors a measly 3.27%. Now, I'm not exactly sure what the dividend yield is here, but doing a quick Google search, you can see it's around 4%. Now, even including dividends, I would say that is a very poor return over the past year. The next fund, let's go into here. This is the iShares JP Morgan USD EM bond, which is a distributing bond. So EM will stand for emerging markets here. You can see over the past year, just returning 2.69%. 1%. Pretty bad investment if you ask me. High expense ratio here at 0.45%. And in terms of countries, we can see emerging markets, Saudi Arabia being an emerging market, although we know they probably have a lot of money. Mexico, Turkey, Indonesia. UAE is considered an emerging market, and we all know how much money they have. We also have notable mentions, the FTSE 100. Over the past year, actually the FTSE 100 hasn't been the worst investment, up by over 11%, and we know that has a decent dividend yield in addition to that. Here's another one, Vanguard FTSE Emerging Markets Distributing Fund, and that has returned 7.74%, which is pretty bad. Here is one from a different provider, Invesco EQQ Nasdaq 100 Distributing Fund. Did pretty decently at over 20% return. But the general consensus here is that, you can go into the most popular ETFs. However, I really implore you to actually do your research behind it. Key things that you should be looking for is, of course, the expense ratio, as a high expense ratio takes away from your earnings every single year, essentially. Dividend yield is not something I'd focus on. I would look at the past performance, look at what the ETFs underlying assets are. For example, if it's heavily weighted on one sector, maybe look to diversify the sectors. If it's heavily weighed on one specific country, then of course, maybe look to diversify that too. And make sure to check out some of my other videos, and I will see you in the next video.